If you are a salaried professional, this is the most critical video you will watch this year. Why? Because two massive government policies are colliding and the result directly impacts the cash in your bank account every month. On one side, we have the new tax regime, which promises lower tax rates, a 75k standard deduction, and income up to 12 lakh potentially being tax free. That looks like a big raise, right? But on the other side, we have the new code on wages, which has a single powerful rule that forces employers to restructure your pay, leading to mandatory higher deductions. So the question is, when these two forces meet, does your take home salary go up or down? In today's video, we are breaking down the complex math with a real world use case to give you the definitive answer. Let's first start with the new wage code. The core concept here is the new definition of wages. Historically, companies kept your basic salary low, often around 30 or 40% of your CTC, and bulked up allowances to save on statutory contributions. The new rule changes this. It mandates that your basic salary plus DNS allowance DA must be at least 50% of your total remuneration or CTC. The impact is simple. A higher basic salary means a higher PF contribution, and your employer's contribution increases, which shrinks your gross salary. And your contribution, that is employee's contribution, also increases, which is deducted from your take-home pay. It essentially tends towards higher retirement savings. Now, the new tax regime. With the latest amendments, new tax regime is extremely attractive. It is now the default regime, offering a standard deduction of 75k for salaried employees, a basic exemption limit of 4 lakh, a powerful rebate under section 87A, making taxable income up to 12 lakh effectively tax-free. If you want to know more about new tax regime, I have a separate playlist on this topic. If you're interested, you may consider watching it. The link is in the top right corner. So this new tax regime is designed to lower your tax liability significantly. But can this tax saving offset the mandatory deductions of the new wage code? Let's understand this with a use case. Imagine your CTC is 15 lakh. In the old structure, where the basic is capped at say 40% of 15 lakh would be your basic salary, that is 6 lakh. On this employer's PF contribution, 12% would be 72k. So your gross salary, CTC as reduced by employer's PF contribution, would be 14.28 lakh. And your taxable income, that is gross salary as reduced by the standard deduction of 75k, would be 13.53 lakh. On this, total income tax, including 4% cess, would be 86,268. That's your first deduction. Then your PF contribution, that is employee's PF contribution, would be 72k. That is another deduction. So your take-home salary would be 12,69,732. Just to remind you, there could be other deductions like contribution to gratuity fund, professional tax, etc. For ease of understanding, we are not considering those deductions. Now coming back, let's compare this with the new structure where the basic is capped at 50%. Your CTC would remain the same, so there's no change in it, but your basic salary is now changed to 7.5 lakh, that is an increase of 1.5 lakh. And employer's PF contribution is changed to 90k, that is up by 18k. So your gross salary and taxable income would now come down by 18k. Because of this, your total income tax gets reduced to 83,460. That's a decrease of 2,808. From this, your PF contribution would be 90k, that is up by 18k. So take-home salary would be 12,36,540. The net effect is a reduction of approximately 33,192 in annual take-home cash, resulting in a lower monthly take-home salary. So, new tax regime versus new wage code. What wins? Well, that depends on one's own perspective. If your primary concern is monthly liquidity, that is, if you have high EMIs, aggressive short-term savings goals, or high expenses, you will feel the pinch. On the other hand, if you aim for retirement security and wealth building, this change is a hidden blessing because your other entitlements like gratuity, leave salary, pension, etc. too goes up. The key takeaway is that you're not getting a cut but a mandatory reallocation from your bank account to your retirement corpus. The tax rules make it cheaper to earn, but the wage rules force you to save more. While the central government has already notified these new codes, these changes would come into effect only after state governments notify these changes. And if this deep dive analysis helped you understand this complex change, please hit the like button, share this video with others, and subscribe so you don't miss our next financial breakdown. Thanks for watching.